Rob Meckstroth, Senior Portfolio Manager here at City National Rochdale. I'm here today to give a brief 2023 market outlook and update. I think this should be no more than 10 to 15 minutes, so I'll jump right in. This is being recorded on Tuesday morning, February 7th it is. So the speedometers page is what I'm starting with. This again is our 6 to 9 month forward-looking view, and a bit ominous in that there are no green indicators for the second consecutive month. And I've been telling people it's my 13th year with the company, and there's only been a handful of months with no green speedometer. So it's a bit ominous, all yellows and reds, but there is some good news baked in. First off, the market has rebounded since it bottomed out in late September of 2022. That's good news for now. The other good news has been inflation. So we've been talking about inflation for probably over a year now. It was the story in 2022, inflation much hotter than expected, and also the Fed's response to inflation, monetary policy, interest rates. It's an aggressive Fed, and this is the most aggressive the Fed has been since the late 1970s. You have to go back that far to find a time when interest rates have jumped this fast and this much. And it's had a huge effect. Contrary to what many people think, the economy was very good in 2022. We were not in a recession. We had robust economic growth, but unfortunately that came with higher inflation. So why does the stock market go down close to 20% last year? It's not necessarily that the economy was bad last year. It's the idea that these high interest rates are going to start affecting economic data, and we believe that's going to happen this year. I'll get into that in a minute. First off, the two green indicators, labor market and consumer spending, when I say green, they were green back a couple months ago. This is a sign that these interest rates are starting to have an effect, especially on consumer spending. The economy is clearly slowing. Now, if you talked to me a week ago, I would have talked about how the labor market seems to be slowing as well. And then last Friday, we got a blowout jobs number. Almost 600,000 new jobs came in the month of January, which was a big shocker. And markets have been pretty choppy since that blowout job number. And it's one of those situations again where good news on economic data might be bad news in terms of inflation and inflation and the Federal Reserve's desire to move interest rates. So why the market goes down when 600,000 new jobs are created? Well, it's because the Fed might have to raise interest rates more and keep them higher for longer. So when we try to project what's going to happen in 2023, I like to pull out our crystal ball page. Now, we've almost finalized the 2022 numbers. We still have final GDP to come. But look, the economy grew 1 to 2% last year. Corporate profit growth was 5 to 6%, but there's the nasty inflation numbers, 6.6%, which was a lower number than at some points during the year. And then there's the final Fed's funds rate, up to 4.25 to 4.5 by end of year. Now let's look at 2023, how we think things will play out. You have economic growth potentially negative for the year. Recession is firmly in play. And a decline in corporate profit growth also firmly in play. In fact, that's probably the base case scenario. But notice inflation. We think inflation is going to come down in a hurry and end the year consumer price index 2.6%. So that's not fully down to the Fed's 2% target, but it might be getting close. Now notice the core CPI is another measure of inflation. Core CPI excludes more volatile food and energy. And notice how that one doesn't fall as far. So this is the measure of inflation that the Fed actually prefers looking at because it's more structural in nature. Food and energy prices can deviate a lot from trends based on weather events, based on geopolitical events. It's the core inflation that I think is most important to get back close to 2%. But notice interest rates at the bottom. We have year-end interest rates still north of 5%. Year-end 10-year Treasury, north of 4% potentially. So what that means is higher interest rates for longer. So this idea that the Fed is going to bring down interest rates by the end of the year, that the market rally that started in January is just going to continue throughout the year just doesn't feel like the scenario that makes the most sense based on the data we see. And like I said before, we're not out of the woods yet. Now, what is our prediction for the year economically? Mild recession. You see where the U.S. is now. The economy is still growing, but the growth is slowing. Where do we end up is one of the key questions of the year. We said inflation is going to come down, but if inflation comes down in a hurry, that could correspond with nasty economic conditions, a mild recession, normal recession. Now, the Fed's dream is that we have the soft landing, which would be the economy continues to grow, even at a slow rate, and inflation comes down. Unfortunately, the soft landing scenario we only have as a 25% chance. Notice the mild recession scenario, 60% chance. So despite better news on inflation, we think it's going to be very tough to keep the economy out of recession as consumers spend down a lot of their savings. And remember, consumption is 70% of the U.S. economy. And if consumers continue to pull back, not only will corporate profit growth decline, but economic growth will likely decline. Now, that doesn't sound great, a 75% chance of recession, but notice that the normal recession or major recession is only a 15% shot, according to our probabilities here. And if you ask me, that might have gone down even lower based on some of the job numbers that just came out. So it's actually pretty good news that the market is pricing in a mild recession to some extent. That's why stocks were down 20% last year. If that's what we end up getting, very possible we do see a positive return for equities this year. Now, 2023 scenarios, we talked about these. I just want to talk about a couple of the circles here in the normal recession scenario. So we said very low odds of a normal to major recession. And why is that? Well, the labor market, most importantly. You're going to need a significant increase in unemployment to cause the economy to go into a major recession. And despite the high-profile tech layoffs, I mean, Amazon, Microsoft, Facebook, Twitter, all of these job losses are getting headlines, but the general economy, the general S&P 500 type companies, you're not seeing layoff activity, even close to the same level. In fact, you're seeing hiring. So it would have to be some event that triggers widespread job losses across the economy, and we just don't see that happening. So again, the case for mild recession, we've got 4 charts here that I think kind of reiterate our view, and I just talked about job openings and the job market. Look at the difference now between 2001, 2008, 2020. We have 4 million excess job openings in this economy. And if you took every unemployed individual right now and gave them a job, and obviously that's not something that would happen, but you'd still have 2 million excess job openings right now. So it would take a dramatic change to go from 4 million excess job openings to something that happened in 2001 or 2008, where you have a significant negative number when it comes to available workers, available job openings. Now, the other important fact, number 1, household debt service burden. So I'm seeing a lot of coverage, a lot of headlines about rising credit card debt, rising consumer debt. But what that's not accounting for is the total income of Americans compared to previous periods. So yes, it is true we're getting close to record credit card debt again, but the total incomes of Americans are so much higher than they were back in 2007 that the debt service burden, how much of the debt payments are against versus income that is being received. That's what this number shows, household debt service payments as a percentage of disposable income. And that number is still relatively low. We're talking about near 40-year lows when you look at it this way. So don't necessarily take, record consumer credit card debt as something that means the economy is going to turn into 2008 again. By no means that is in the cards. A couple of other ones, banks are very healthy compared to how they were in 2008. So you're not seeing the Lehman Brothers type situations happening. In fact, banks may be too conservative right now. And the other idea is consumers, although they've spent a lot of money on goods over the last couple of years, services activities still have not come back quite all the way based on pre-pandemic levels. So consumers still have some room there. So I'm just going to hit on a couple more slides. One I think is fascinating to many is just what's going on in the housing market. So obviously when the Fed raises interest rates and rates go up, look at what happens to mortgage rates. They went from historically low up to levels we haven't seen in 20 years. And of course, when mortgage rates jump that quickly, that fast, look at the cost of the average home. Doubles in cost from where it was pre kind of pandemic level. So whenever you have a doubling in the cost of your mortgage payments, obviously new and existing home sales are going to decline 35%. This is just a good example of what happens when interest rate pressure goes up. It starts breaking things. It starts causing pain in different sectors, and the housing market is usually one of them. Now, the good news when it comes to housing is mortgage rates have leveled off. They've actually come down just a little bit from their highs. So again, it does not appear like a 2007 type housing bubble that's in the cards, but housing may be weak for a while. Now, transitioning to inflation, we talked about a 2.6% inflation number as our year-end goal, and year-end forecast, I should say. Now, the left side of this chart, I'm not going to break it all down, but notice that housing is 40% of the consumer price index. And to me, this is going to be the biggest changer from 2022 to 2023, is that we just talked about a weak housing market. As of the end of the year, housing was still one of the biggest contributors to inflation as we went into November and December of last year. That number will come down. It may take a few months. Housing, they actually use a statistic called owner's equivalent rent to try to judge what is the change in housing costs. And mortgage payments have gone up, but you're going to start seeing a drop in rents. You're going to start seeing a drop in home prices. And that's going to start showing up in the data in the coming months. So it's going to be much tougher to see a growth in inflation when one of the biggest components, being housing, is going to weaken. So that's one of the projections we feel very good about. Finally, just a couple of things to wrap up with. 2023 issues to watch. We talked about inflation moderation. We talked about mild recession. The bottom chart here shows the overall value of the stock market. So price-earnings ratio. What is the price of company stocks versus how much are companies making? So we talked about earnings may start coming down a little bit. And if prices don't come down much, that makes stocks more expensive, all things equal. So despite the fact that stock prices have come down a bit, stocks are not necessarily overly cheap right now. They're not screaming buys, especially with the rally in January. So it's not, valuations are not the only metric when determining whether it's right to be in the market or not, but it's something we watch closely, especially the aggressive tech stocks that have fallen so far. I mean, there's a lot of overvalued stocks despite the fact that stock prices are down. And just kind of concluding, we're coming off of this year that stocks were down 18%, S&P 500. The blue bars represent the calendar year returns for stocks going back to 1980. So a minus 20% year is an abnormal one, but it's not one without precedent. We have many minus 20% years over time, followed by nice bounce backs. That's part of the market cycle when it comes to stocks. But notice bond market. The bond market has been incredibly stable for 40 years. The blue bars represent the annual returns, and the worst bond return year, you see a minus 2.9% in the early 90s. Fast forward to 2022, minus 13% for bonds. So 2022 was so tough because not only were stocks down double digits, but bonds were down double digits as well. So when you build a portfolio, for clients of ours that build portfolios with us, you structure your portfolio with these indicators in mind. So when we have reviews at some point, we'll go over the strategies. But for now, very interesting year coming off of double-digit losses in stocks and bonds. But overall outlook, mild recession, likely outlook for the economy, but you have lower inflation. So I think we're going to have less of a focus on inflation as we get through this year and much more talk about recession. So I hope this was helpful. I look forward to doing this again soon. Thanks so much. you.